Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for January 21st of 2024. Starting off the chart pack this week, we'll have a little bit of economic data here for you. This is the U.S. Beige Book published by the Federal Reserve, kind of a composite of activity across all the Fed districts. And what we see here in that blue arrow there on the far right is a noticeable uptick in this data. And so anything below zero represents kind of a contraction. You can see the gray shaded bars there, those represent recessions. And so, with the gradual downtick over the last, quite a few months, in fact, and actually having that go negative was painting a a much stronger recession signal, I should say. But the number has perked up. And so, I think it goes without saying that the optimism level heading into 2024 is actually pretty good. We ended the year on a lot of optimism, certainly in the equity markets. And a lot of that had to do with this feeling like, oh, we are definitely going to avoid recession. And oh, by the way, we're going to have a bunch of Fed rate cuts. And so we're here to talk about that a little bit today, but just, looking at the data that comes out of the Fed, it certainly has been better than we've seen it. Here we have some retail sales data. We've been monitoring consumption as a rule for at least the last year, looking for signals for recession. Obviously, we have not had that recession or really even a major slowdown that we thought we might have because the consumer's been pretty good. And real wages have gone up, and so that's provided more money in the pocketbooks of Americans to go spend. And we see in the data this month that we have a noticeable uptick and kind of a real interesting trend over the last 3 months following a fairly strong period of consistently positive data. And we thought that was going to turn. We were watching for an inflection point. It actually didn't happen. It went back up. And some of that has to do with the fact, as I said, that we do have real wage growth now for the first time on a sustainable basis in quite a while. This is a survey of the New York Fed looking at people's sentiment with regard to where they think they're going to be 12 months from now. And so what we have in the blue line is definitely an uptick following a period of pretty somber expectations. Here's the pandemic. We were at a kind of a relatively high level here, in terms of confidence. This is people feel like they're going to be worse off, and that was trending lower in the pandemic, and then that jumped up. And then now that's trending down, and we see this inflection point here. So people that feel like they're going to be better off 12 months from now is going up. Those that feel that they're going to be worse off is going down. So that goes back to the confidence factor that I mentioned at the outset. Now we'll talk about the probability of recession. This is what I mentioned in my opening comments here. You can see that probability is going down. We're now kind of settled somewhere in the 40% range. You see a lot of Wall Street firms that are still kind of 50-ish. You see Goldman Sachs is down basically 10 to 20%. They're not looking for it at all, whereas JP Morgan might be up closer to 60. But you can see here that this is an average of a bunch of different economists, and clearly the sentiment is becoming more favorable to that soft landing. Expectations on interest rates are actually pretty worthwhile to pay attention to. Again, the sentiment is still out there that we're going to have a lot of Fed rate cuts. Now, I would offer that I really don't think that we're going to get as many as people think, unless there's some major policy mistake which causes some economic stress. But based on what we can see out in front of us through the front windshield here, so to speak, would expect something that's going to wait until a rate cut that's going to wait until later on in the year, and then we wind up not having as many of them. But having said that, you've got looking out into the future, you've got a year and a half. And where we were 3 months ago was clearly a downplane in interest rates from where they are now. This is short-term interest rates at roughly 5.25. And then the expectation is, 12 months from now that those rates are going to be down probably about 3.75. So you're going to get, essentially, 1.5 percentage points of rate decreases over the next 12 months. Now, that to me sounds like, 5 rate cuts at 25 basis points or, quarter point apiece. And again, this might be a little aggressive, but this is clearly the market expectation. And so you get out a year and a half and they're looking more like 3.25. And again, I just want to, call this out to say that the optimism level has certainly been built into the market. And what we want to guard against is this turning out to be overly optimistic, and then you get a negative surprise, and then market volatility picks up a little bit. Here we have probability of March Fed cut, a rate cut, and that has dropped noticeably from really the end of the year. That was pretty much 90%, basically a foregone conclusion that that was going to happen. And I was a skeptic from day one, and so here we are back down to around 50%. So that probability has definitely gone down. We talk about interest rates and mortgages. Here we have the U.S. average 30-year fixed mortgage. It has definitely come down. We're seeing that kind of in a 6.6% range, clearly following a major ascent, which was, highly dislocating to the market. But here we have expectations on mortgage rates. So, as you would expect, it would follow the natural course of interest rate expectations. And so here we have that the percent of people that are feeling like mortgage rates are going to go down has clearly moved higher over the last several months at a noticeable clip, whereas those who feel that it's going to go up are definitely trailing off. Now we talk about household expectations and kind of, where they see themselves over a longer period of time, not just 12 months or whatnot. But this is, probability of what consumers feel like is going to be a comfortable retirement. And so, essentially this chart is telling you that people feel like it's going to be harder to achieve that retirement lifestyle that they expect. And so this is putting more pressure on planning. It's putting more emphasis on getting into the planning process a lot earlier, not waiting, and being more diligent in terms of saving while you're in your peak earning years. And so, as the headline here would suggest, households in general are getting a little bit more worried about being able to attain that retirement. So I use this essentially as a call to action, particularly for, that younger cohort. We'll talk about interest rates for a second. Here we have the 10-year Treasury yield in the black line on this side, and then you've got your 50-day moving average. And we're getting ready to kind of, they call kind of in equities, they call it a golden cross, where you move up ahead. But in this case, this represents your interest rates. So, we had a major decline in interest rates at the end of the year, again, tied to that feeling that we're going to have a lot of these rate cuts this year. So the expectation for 10-year yields went way down. And I think it just got oversold, and now it's moving back up a little bit to around 4.2%. And so, technically speaking, if you punch through your 50-day moving average, there's a chance that you could wind up, here around 4.4, 4.5. But, we'll just have to wait and see. And obviously, we're going to have a lot of news flow coming over the next several weeks with earnings reports, et cetera. And over here we have the 10-year Treasury bond ETF, and we see that also with the ETF, which in this case it's inverted. So while we have this moving up, this represents interest rates moving up. This actually represents interest rates moving up too, because, not to confuse you too much, but this is an exchange traded fund. So this is a price, and so yields move inversely with prices. So as the basically, as prices are moving down for the ETF, you're having 20-year yields moving higher. I thought this was very interesting. Usually I kind of kind of put this at the end of the chart, but what this is telling you is that according to the Labor Department, as reported in an article in the Wall Street Journal I read last week, you have more households and just in general, fewer survey respondents to all of these economic surveys that are so important to kind of determining the pace and the course of our economy. You see like respondents here, like on CPI housing data in 2014, you had a 71% response, and now that's 58, and you've seen like population surveys going way down, employment cost index surveys, respondents going way down. And so what this is doing is kind of like, and particularly these over here, are kind of calling into question maybe a little bit, the statistical significance of some of the survey-related data that we look at on an active basis. Is it relevant? Is it truly representing a consensus view? And so with some of these numbers, some people are maybe asking that rhetorical question a little bit. So to talk a little bit about the corporate sector, we spent a lot of time on this. Showed you some charts last week that kind of indicated that the kind of the near-term uptick in bankruptcies and kind of corporate stress is really, if you spread out your horizon and look at it over a period of like 25, 30 years, it's really not that bad. And this is more corroborating evidence here as we look at cash on the books for corporations. We're still above this long-term trend line. Also, if you look at interest coverage ratios, this is the ability for companies to cover their debt service payments, even though interest rates have moved higher. You have companies that are actually earning more on cash, and so this is the interest coverage ratio right now, and we're about 4.5, and that is a standard deviation above the mean. Granted, it's not a real tight fit. You've got a lot of variation here, but bottom line here is that coverage is good, so corporate credit is in pretty good shape, cash is in good shape, and the cash too that is being held on the books is now earning a lot more money than it was. We've talked a little bit about private credit over the last several months, and this is kind of what I'll refer to as the non-bank banking sector. So these are funds that are doing direct loans to borrowers in what I'll call the middle market, more expensive financing at a point when the commercial banking sector is becoming a little bit more persnickety, and credit is clearly tightening in that sector. So you've got these non-banks that are lending, and by these charts, this one in particular, they've got a lot of dry powder, and this whole sector has really grown in significance and its influence on the total credit sector over the last several years. But you can see plenty of dry powder over here, and you've got the ability for these funds to raise more money than actually they can lend out. And so, but here too, you have an indication that private credit, the standby liquidity, if you will, as a percent of total consumer and industrial loan demand is rising rather significantly. So, when we talk about credit being tight, I think we have to factor in the private credit sector, which has really become a lot more prominent over the last 5 years or so in meeting credit demand, even though that cost is a lot higher. When we talk about corporations, we got to talk about the consumer here. So households, we still have pretty high savings, all things considered. We talk a lot about how the stimulus benefit has waned, but our savings rate on, and just be clear, this is a 4-year annualized rate. So this is kind of a moving average. But when you look at it on a trailing 4-year basis, again, we're over a standard deviation above the average, which is a pretty powerful statistic to say that the overwhelming majority of your occurrences, your observations here are above that line, and that's exactly where we are right now at 8.5% savings. And then household liquid assets, we have more households that own liquid securities. This obviously would not necessarily mean like your house or whatever, but basically cash and money markets. And obviously, we'll see in a few slides here where that still remains really, really high. We've got a lot of dry powder on the sidelines. But even despite these tech bubbles, global financial crisis, and then the COVID bubble, you see household liquidity almost a little parabolic here. It's not just a linear growth, but it's actually accelerating. We look at housing prices. We do have a 3-year change number that we're looking at here. And even though we've had a little bit of softness and I'll call it deceleration in housing prices, we've actually seen a tick back up in prices. And you can see that prices overall are well above their standard deviation. And so, and despite the fact that we've got high rates, and we've talked about how the speed at which rates went up was highly dislocating for the market. And it caused a huge ripple. And I think we're kind of working through that. You see home builders really get aggressive. That's a much smaller component of the overall housing market, but we're coming off a historically low existing home sale number, the kind of the lowest number of sales that we've seen in a while. And market's still dislocated, but despite the fact that we've had higher rates, we still have a really tight housing market, and I think that is going to persist for some time. Talked about the labor market and the things that are sticky with regard to inflation. We also talked earlier about how real wages have gone up, and so this is one indication of that. These are employment costs on a 3-year rolling basis, and some of that has to do with the fact that the participation rate is low, and and not to say it was declining for essentially 20 years before we hit the pandemic, and then if you just kind of like back that out and said that this is an anomaly because you artificially shut down the economy, that where we are now is still below the levels that we exited 2019 at. We have inflation, looking at price levels, and this is basically an overlay of the core CPI, the observed data that we see, and we have obviously a little bit of acceleration here, just near term, but if we look at the 3-year change, we're still at levels that are clearly higher than where the Fed wants. And if you're kind of at these levels, even though the 3-month rate of change in CPI, the annualized 3-month number is extremely low, the Fed's going to be very hesitant to want to reduce rates as long as they see that growth remains relatively strong, which we just showed you in retail sales, and that inflation is still reasonably above its projected goal there. What we have here is just kind of a general indication that financial conditions are actually somewhat easy, all things considered, with banks being relatively tight. Here's a Goldman Sachs U.S. Financial Conditions Index on a 2-month change, and you can see where we are now. Fairly strong, easing of conditions as you see some of these interest rates kind of settle out a little bit more. A couple more data points here on the corporate sector. We've mentioned before about bankruptcies, and if you looked at a very tight window of data, like literally over the last 5 years, you'd say, all right, bankruptcies came down, and then boy, they shot back up. And that is meaningful when you're looking at data, in this time frame. But if you go back a long way, we've had recessions here, and then we had, in 2008. But basically, you see a pretty marked downtrend, and here we are, with 5 percentage points of rate increases, and we still have not seen a spike in this. Now, that's not to say that it won't happen, but we just haven't seen it yet. And I think a lot of smart people expected this number to spike last year. But again, very positive. Now, if you look at interest expense as a percent of overall profits, that's going down here. And so, like I said a couple slides ago, we have companies that are still earning reasonable amounts of cash. And what's happening is, even though they're paying more in interest on their debt that they may have to roll over, they're earning a lot more interest on their cash deposits. And so when you net all of that investment activity out, where it plays itself out below the operating line on the financial statement, what you get is this, that overall interest expense and that burden is actually going down. We have Suez Canal. This is something we're going to continue to have to monitor. I'm not convinced that this is going to be, a huge albatross, but it's going to be something that just kind of sticks in our craw for a while. Is it possible for the Houthi rebels to, sustain a major campaign? No. Can they be pesky and irritate people and cause shipment volumes in the Suez to drop like a rock like this and stay there for a while? Yeah. And as we showed you last week, when you combine that with Panama Canal witnessing, drought conditions, so the lakes that fill up the locks there are very low, and you can't get some of the larger container ships through there. So this is going to cause freight costs to go up, cost of business to go up. Shipping overall, I think, is going to, it's just something that we're going to have to pay attention to. Look at some Philly Fed data, just to remind us that with all of this positivity that, we still have sluggishness in the manufacturing sector. So here's the overall index. We're below 0, which shows contraction. We've got new orders that are still in contraction. Expected shipments, which basically, almost retouching lows from 22, and then expected number of employees, hiring. The labor market remains strong, real wages are positive, but yet here in manufacturing, it still is struggling. And so I like to say that I think there are pockets of manufacturing that are doing quite well. When you say clean room, fab manufacturing, anything that's benefiting from the CHIPS Act that was legislation passed several years ago, those areas are booming. Now you have a lot of areas within the manufacturing sector that have not yet seen that improvement. So, with all the positive things that we can talk about, let us not forget that there are clearly pockets of the economy that are kind of dragging along. So, this one's directed to the younger generation. You look at this chart from Charlie Bolello, last 30 years, you've got a 10% annualized rate of return in the S&P 500. So this, in a nutshell, is the power of compounding at its best. And this is what we use in financial planning. Now, it requires a unique diligence of sticking with your plan. Now, that's not to say that everything moves in this straight line, but that's just where we are. If you have the perseverance, that line, if your cutoff point was here, that line looks a bit more like that. So maybe that's not 10%. But longer term, this is actually what we spend a lot of time. And again, when we say longer term, this is 1995. So again, 30 years, point to point, annualized basis, 10% return. Should be a call to action for young people to start saving money away. Let that compounding work for you. Take a different perspective on this chart, just looking at cash. We've spent a lot of time over the last year talking about cash returns, and people get real comfortable with that. And, and we've taken advantage of those high rates, and we do some things like CD alternatives and even for some clients, rolling treasuries. But let's be clear that there is power of compounding, and that last chart was very illustrative of how that works for you over time. Now, if you compare cash returns to the S&P 500, well, I'd say you have one in a 3 chance of having your cash returns exceed your stock returns. And 2 years it goes down to about 1 in 4, and then so on and so forth. And obviously the power of compounding in the equity sector means that if your investment horizon is 10 to 20 years, then you're somewhere between you have basically between a 1 and a 15% chance of having cash outperform. And so this is when I say you have to have an investment policy statement which guides and informs your thinking, and it keeps you diversified. And if you look at this and pay attention to it, you know, okay, listen, there in the short term, maybe I can take advantage of it, but are you quick enough to get out of it when interest rates are moving down? Are you quick enough to pivot and time the equity markets when they're at their lowest? That's very hard to do, and you might get lucky, but it's very hard to do over the long term. So the takeaway from this is, take advantage of high cash returns when you get it. Not necessarily always going to be the case, but just make sure that you don't be under invested to your policy statement in the S&P 500, because if you go longer investment horizons, you're going to tend to be caught with a lower overall return if your focus is on those cash returns solely. So we'll look at the S&P 500. Interestingly enough, we are 11% higher than we were just before the first Fed rate hike. So we've had basically, it shows here 525 basis points or 5.25 percentage points of increase in the rate. You can see all these step ladders here. So we had all of these consecutive rates, and then we've been holding steady for a while. But amidst that, we had an equity market, back in 22 that we know was really struggling, and even to some extent the first half of 23 was really challenged, and then we ended on a high note. And we're actually 11% higher than we were before rate cuts went into effect. Here we have a chart on money market funds. Clearly, this represents a lot of dry powder, and so when we look at this chart, the y-axis here is basically in trillions of dollars. And so looking at where we are literally about $9 trillion of time deposits and money market funds. This is an extraordinary amount of dry powder. And you look at, equity cash that's sitting on the sidelines. I mean, this is it right here. You're looking at, savings that are, held in reserve that may not be, you have a lot of people that haven't committed to risk capital investment yet, even though you've got people that are, definitely jumping in with 2 feet right now. But you have a lot of dry powder on the sidelines, and I think this is a positive for the equity markets. A couple of things to update you on, which I thought was very interesting. This is from the Daily Shot, and student loan payments, went out of abeyance around September, October of last year, and had a lot of students or former students that ramped up their payments. And Oxford Economics here is showing us that the rate of payments are going down quite a bit. So, what is this a sign of? Well, it could be a sign of stress that, the additional $200 a month coming out of a young professional's budget or postgraduate, coming out of their budget is becoming a hindrance, and they're choosing to put food on the table and finance experiences over these student loans. So we'll have to see where the default rates go, but clearly we're having a payment history that looks to be eroding a little bit. We have household checking deposits. We've been talking a lot about excess savings, and so I think the key takeaway here from this chart, at least for me, was the fact that even though you've gone through this bubble, you had a lot of the stimulus payments, you started spending that off, and we know the excess savings has been going down. No surprise there, but if you look at basically the nominal linear trend for deposits as it was defined before the pandemic, this big dislocation, we're just now working our way back to normal. So this trend line continues like that, And we're just getting, we're getting closer, in this case, about 1.2 trillion of what would be defined as, maybe in some cases as like excess savings that have yet to be spent. So again, situation from the consumer standpoint, absolutely not dire. We know that dry powder from the consumer side is going down, but as we just saw in that last chart, that overall money market and time deposit liquidity is really strong. And you have to consider that when you're talking about the viability of the equity markets and the investment markets overall. Money supply growth, we've talked about a lot. And as you can see here on a year-over-year basis, that number's going down. And so, basically we've got money supply in the red. And you can see that basically this is advanced 18 months. And you can see that that's moving down considerably. So as this headline would suggest, declining money supply is almost always eventually disinflationary. And I think this is in some measure what's contributing to the decline in the CPI, which happens to be this blue line right here. And so again, this number, I'd say the correlation here is probably somewhere like a 0.6, 0.65. So it's not real tight, but there's usually a lag when you have money supply growth, which it deteriorates as it has been, and then the CPI number following it eventually. And I think that's what's going to happen. So I do feel like, okay, that inflation is going to get to a Fed's target. I just think that the occurrences of that may take longer than people are expecting, and that in turn will delay these interest rate decreases that everyone's been talking about. That's all we have for this week. Really hope you have a great week. It's going to be wet down here in Texas. We're going to get a lot of rain. We never complain about that. Be a little bit warmer than it has been, so I think we're all looking forward to that. But wherever you are, hope you have a fantastic week and look forward to talking to you again soon. Take care. Bye.